Good, good morning, good afternoon to everyone, and welcome to this webinar, Silver Linings Playbook for the Asset Management Industry, Driving Growth and Profitability in an Uncertain World. My name is Balaji Ramakrishnan, and I look after Acuity's asset management and banking business in EMEA. For some housekeeping details, all webinar participants have been muted already. So if you have any questions, please submit your questions through the Q&A provision in the chat window at the bottom of your screen. There will also be 4 polling questions as we go along, and we kindly ask you to respond to those as well. We have with us today 3 distinguished panelists. We have Bill Street, Group Chief Investment Officer, Quintet Private Bank. We have David Master, Global Chief Marketing Officer, Janus Henderson Investors, and Mike Tamilty, Global Chief Operating Officer, Standard Life Aberdeen. We also have with us Dr. Paul Alaput, Chief Product Officer, Acuity Knowledge Partners, who will be moderating this session. In terms of webinar attendees, we have a wide range of attendees from the UK, from continental Europe, and the US. Excellent representation from the asset management and private banking industry. First, a very quick introduction to who we are. Acuity Knowledge Partners is a leading research and analytics service provider working across the financial services industry, 3,000 plus domain specialists serving 300 plus financial services clients with a very strong focus on the asset and wealth and private equity and venture capital space. At the heart of what we bring to the table is very deep domain expertise, strong automation capabilities, and process knowledge. And the work that we do is across investment research, investment operations, fund marketing, investment compliance, and data sciences. With that brief introduction, I'll hand it over to Dr. Paul Alaput to take things forward.
Thank you, Balaji. So good morning, good afternoon, good evening. We are delighted to have this gathering of experienced buy-side professionals for this webinar focused on the state and the challenges confronting this industry. Since we started this series of webinars almost a decade ago, this is one of the largest gathering of buy-side professionals we have assembled. So thank you very much. We are also, today we have experienced a panel of industry veterans, battle-hardened, if I may say so, who will share their experience and insights over the course of this evening on the state of this industry and the outlook during this challenging time. While we go through this strange and uncertain year, I think as custodians of people's financial aspirations, I believe the asset management industry, the asset managers, the wealth managers are second in importance only to the healthcare professionals. Through their financial discipline and patience, they safeguard and nurture and enhance people's savings and wealth during this turbulent and uncertain time. Meanwhile, the industry is going through a lot of churn. There are a lot of immediate and long-term challenges. Start with demographics. I mean, the investor population is rapidly changing. Millennials are rapidly supplanting baby boomers, and they come with different aspirations and different needs. We have a global surplus of financial savings with negative interest rates in almost several advanced markets. We have rapid technological transformation. We have a lot of avenues for data gathering, for large databases. We have new tools and analytics. We have a greater focus on investor protection, on transparency, and regulatory change to enable that. We have greater demand for client customization, for personalized portfolio construction with scale. So there's a lot of demands on this industry coming from various directions all at the same time. So how effectively companies navigate this, confront this, and in some cases overcome them will determine the success and relevance of this industry into the coming years. So over the course of this evening, I hope to tap the collective experience and expertise of the panelists, and later in the Q&A section, the audience, just further a better understanding of where this industry stands and what lies ahead. So with that, I'll start the panel section, and we have three panelists. We have about 40 minutes we will devote to this section. It's divided into four sections, three questions each. And the way it's designed is that we start with big picture, long-term issues, and then go into more operational and more short-term topics. So starting with the state of the industry, I'll start with Bill. As we head into a year of a lot of change, new US president, major changes in economic policy, Brexit, pandemic-related economic disruption. There's a lot of event risk that is ahead of us. What are your thoughts on the year ahead and the immediate future, Bill?
Thank you, Paul. Hope you can hear me okay.
Yeah, we can hear you.
So you used the reference of battle-hardened guests at the beginning of the intro, and I certainly feel like I've been in the battle through 2020, and I suppose coming into 2020, I thought I'd seen the majority of the things that the markets could throw at us up to the end of 2019. Never thought I'd see a global pandemic. However, we seem to be getting through this, and this was the sort of archetypal black swan event. And look, if I look on both sides of this, on the positive side, the industry as itself has demonstrated a lot of resilience in terms of its ability to discharge its fiduciary duties through very troubling times, uncertainty, and heightened volatility, and stresses on liquidity. And maybe we'll come back to some of those elements later on in this panel discussion. But you overlay what was always going to be a difficult year anyhow, because we knew there were known knowns such as Brexit, and there were known knowns such as a US election that was always going to be a different US election because of the protagonists involved. And then you overlay that from COVID, which is the definition of uncertainty, because even the best scientists in the world had no sort of exit path for this. However, what I would say is that I think on the positives, the industry as a whole, I mean, not talking about performance, but the resiliency of what it does has been tested, and it stood to account. And going to your question about how we look forward, I think the industry may have maybe a slightly different set of challenges, and maybe rebase the question. We are actually probably coming out of a tail event and heightened volatility. And I think we are potentially in 2021 coming into a very pro-cyclical environment for a whole host of sort of semi-artificial reasons, like artificial levels of stimulus, both fiscal and monetary policy. And with that sort of framework, what we do know is that the policymakers have got a very pro-growth and pro-inflation agenda in order to repair some of the damage we've seen in 2020. What that means for the asset management industry is whether they actually achieve fiscal inflation or not, we don't know. But I think we are probably, the balance of probabilities is that they will achieve asset price inflation. So we will have this unusual period, maybe 1 or 2 years, where we're going to have strong asset price growth in a world where we are going to have very different challenges in terms of asset diversification because of what they're doing with regards to things like the discount curves. And I think you mentioned this in your intro. We are at the zero bound for basically across most of the G10, G20, and negative real rates across a lot of the curve. This creates a whole different set of challenges for the industry, which is different from the orthodox in terms of how you value risky assets and how you put valuations on different types of asset classes. in this world where you have duration, which is your principal point of a lot of present valuing of asset prices being negative or flat, depends whether you look at real or nominal rates. So what do we do with the bond market, and what is the natural proxy for bonds going forward? That is going to be a real difficult one for the industry as we look at the various investors. And there's going to be a raging debate, and I suspect we're going to get onto this between passive and active. And there's going to be a raging debate between public and private. And what I mean by public and private is that where are the risk premia, where the returns going to come from? And this will drive all the way into retail and will drive all the way into the institutional frameworks, especially things like liability-driven frameworks, the pension funds, which will have to be looking at different forms of valuation exercises. I think this is all we're getting into sort of modern monetary theory here, where we have this huge convergence of monetary and fiscal policy, both very much twinned at the hip in terms of creating a different set of outcomes going forward. So I think the challenges ahead are very, very different than we've seen in the past.
Thanks, Bill. I mean, definitely not a year for amateurs or new entrants. I mean, going to really test everyone's experience and knowledge of previous cycles. Turning more to the client experience, the marketing side, Dave, I mean, it's almost like there's increased demand for customized client experiences, more personalization of portfolio construction, and all of this done with scale. In your view, is this now table stakes for survival? I mean, is this something that every firm has to address if they have to be successful? Your thoughts?
Yeah, thank you, Paul, and good to be with everyone today. And I think the answer to that is yes. I don't think there's any question that investors are constantly looking for more from managers. And I don't think it's entirely a function of the pandemic either. I think this was happening, this is a clear trend prior to this year as well. But it does vary meaningfully by the type of investor we're talking about. In terms of portfolio management, institutions are increasingly focused on the specific outcomes they're trying to achieve. And some are bringing their own strict parameters relative to how a portfolio is created. A growing number are looking for solutions that address concerns about lack of correlation with classic asset classes, portfolio protection, and tail risk management, with criteria relative to drawdown or dynamic asset allocation. And these types of approaches often take advantage of multi-asset and or alternative strategies rather than classic long-only strategies. Another area, and I do look at this through the eyes of an active manager, is the creation of unique custom indexes that leverage a firm's intellectual capital and offer financially engineered products that are quite different from other passive products. And then on the reporting side, institutions want flexibility really to meet any unique requirements they may have and are becoming particularly demanding in areas such as ESG. Now for individual investors and wholesale channels, platforms are de facto institutions, and they may also look for customized investment solutions. But of course, it's much more difficult to deliver products that are actually customized for end retail investors on any sort of scale basis. So rather, what we're seeing is a very strong level of interest in assistance with overall portfolio construction on the part of advisors. And that often takes the form of product neutral analysis that can help them derive a comprehensive understanding really of the risk and return drivers, detractors, and the dynamics of the portfolios they're managing. And that can be accomplished through metrics such as value at risk, downside and maximum drawdown analysis, risk budgeting, correlation analysis, and factor return decomposition. In doing so, we can help them navigate volatility and find pockets of potential performance they may not have seen. In fact, we've seen institutional appetite for this as well. The challenge here, however, to really reference what you mentioned, is to have scalable technology-based solution that can support such analyses, because you really can't handle it just by staffing up with more and more people. It's not economically viable. So the bottom line, I don't think this is a surprise to anyone, is that asset managers have to listen to their clients as never before, understand their needs, and show how these can be specifically addressed to a much greater degree than might have been the case in years past, whether through products or associated services.
Sure. I mean, yeah, no, customization and scale are fairly challenging objectives to sort of reconcile all at once. Hopefully, technology and analytics will offer help us square that circle. But we'll and go to that later in the panel discussion. Before we go on to Mike, we'll put up a polling question, live polling question. So this is for the audience, and you have 30 seconds to just pick one of this. And we sincerely request everyone participates. The more responses we get, the more valuable these the information we gather. Sid, I think, thanks. So turning to Mike, I mean, one of the themes that I think Bill also touched upon was this whole active versus passive management. This whole rise of passive management has probably been the biggest trend if you look at the last 12 years post 2008, etc. It's been sustained, it's been consistent. AUM inflows have been significantly bigger than inflows into active management. It's been very disruptive in that it's put pressure on margins, it put pressure on information efficiency, market information being efficient, etc. So what are your thoughts, Mike, about how the industry is coping with this some ways disruptive change?
Yeah, no, I mean, I think both Bill and Dave have summarized it really well. And I think it's about client centricity. It depends on who your clients are. It depends on ultimately the assets that they have available. It depends on their liabilities. So for institutions, managing pension schemes where they're pretty clear about sort of future liability strain, then there is definitely the opportunity to look at some liquidity premia and make use of alternative asset classes, whether they be real estate, private equity, infrastructure, possibly private credit, to effectively sort of give them the returns that they're looking for, because they can take a longer term perspective. I think it's then different, as Dave rightly highlighted, in terms of whether it be more wholesale or whether it be more retail, that they want to take a different perspective, personalization, and probably have a different time horizon potentially than institutional clients, where they have the benefit of being able to pool all of those assets together. But I think without shadow of a doubt, it's not really binary. I think I absolutely agree with Bill, is that you could get, because of the stimulus on the back of the pandemic, it being pretty pro-cyclical, but ultimately that doesn't necessarily mean to say that we're all going to jump into passives over the course of the next couple of years, which you're right has absolutely been the case. Significant growth since the global financial crisis. But to my mind, it is about trying to combine both passive, active, but actually there is probably a third, which is the whole alternatives, and that would certainly expect from a margin perspective, higher fees than ultimately have been paid for pure passive. I think one thing that I think we touch on in all of this is transparency. And what's pretty clear is that investors, no matter whether they are individual, whether they are advised, or whether they're institutional, effectively will look to ensure that they get value for money for ultimately, the fees that they pay. And I think we're all going to come under continued scrutiny to be able to demonstrate that the investment decisions we're taking are generating value for clients. I don't think that will effectively ever change. And a lot of the regulation which ultimately is coming into play, in the UK, for example, assessment of value, MiFID II, a lot of that regulation was effectively designed to create much greater degree of transparency. And I think that's here to stay for sure.
Thank you, Mike. So before we close this section, we just see what the audience had to say. Sid, can we see the results? So in terms of current state of global asset management industry, I think majority felt expansion to alternatives is critical. And I think I'll go back to earlier comments that this industry is quite resilient. So I think nobody claims its best days are behind. Okay, thanks, Sid. Going on to that second section, it's a little more focused on active asset management. And again, now, one of the big themes of the past 12 years has been a huge and sustained fund inflow into the 10 largest fund managers. I think the estimate is something like 80% of fund inflows since 2008 has been to the 10 largest fund managers. We are now seeing a wave of consolidation, several high-profile names merging, etc. So this question to Dave is, and I mean, James, you have personally experienced some of that. Is this a trend that we are going to revive again, a lot of concentration into bigger fund managers post this pandemic crisis?
Well, I don't know if I want to say I have a crystal ball on this topic. It's easy to say that industry consolidation will inevitably continue. And, the motivations for asset managers to combine are obvious in terms of synergies around expenses, accessing different geographies, and filling in product gaps. However, the prospective benefits of combination are not automatic. And there's been quite a bit of discussion of late as to whether they are always realized, particularly as firms get larger and larger. And the challenges of combining firms should not be understated. I don't think it would come as a surprise to anyone, but integrating people and infrastructure and technology can be difficult and time consumptive. Eliminating redundant products can be hard and alienate clients. Larger firms can become less spry and less responsive. And culture clash can be disruptive or create dysfunction. So all these factors can lead to client frustration and work against realizing the anticipated benefits of greater scale. So while more concentration of firms rather naturally leads to greater concentration of flows, flows are also driven by product capabilities, by performance, and by client preference. And those are not the sole purview of mega firms. So perhaps the real question is whether there's some minimum threshold of size that a firm needs to have today in order to survive and prosper. I do think consolidation is likely to continue, but I don't think all combinations will prove particularly successful or satisfying, and that becoming a mega firm may neither be necessary nor desirable to provide value to clients and shareholders.
Thank you, Dave. So, I mean, it's really not a silver bullet. I guess in some cases it works, some cases not appropriate. But thanks for the perspective, Dave. Bill, you wanted to add something?
Yeah, I just, I completely agree with Dave's comments. Maybe I sort of turn it slightly upside down, which is that ultimately, what does the client get out of greater scale? And the question may be, actually, there may be more consolidation in the passive universe than you do in the active universe, because you've got a few mega companies in the passive universe which do actually benefit not operationally from scale, but actually from market operations through scale as well, because they're trying to get better market access and liquidity. That is quite different from some active managers. And I suspect we will see an industry that's barbelled between the index managers and the true sort of boutique active managers that don't need scale, they need expertise. And I think the industry may consolidate in a slightly different way.
Interesting, yeah. So it's basically you're saying that more likely that you'll see more consolidation on the passive side, yeah?
Well, yeah, the indexing business is becoming very commoditized, and like most commoditized industries, whether it's a financial industry, you need scale and production of scale. And I think, you know, you could make the parallel with the car industry or whatever. You will get these sort of boutique, high-end active managers, and then you probably get the mass production. Right.
Yeah, makes sense. One of the big themes, especially in Europe, but with global implications, has been MiFID II. So, Bill, what's your thoughts on that? I mean, has it been as anticipated? Has it been more severe than we planned for?
Well, MiFID II is the sort of the gift that doesn't stop giving if you're an investment manager, because it seems to have been an eternal project. If those of you that have been involved in delivering MiFID II in any shape or form, but it's easy in that context to get quite cynical about over-engineered or over-bureaucratic regulation. But I think it's worth, you know, taking a step back in a way as industry participants and look at what happened to clients over 2007, 8, and 9. And can we all, as a collective here, look back in that period and felt that the industry was working in the best interests of the clients and the clients' outcomes? So, and I think generally, majority of people would say that the outcome of those events was not great for investors. So you have the sort of evolution of MiFID II, which is really driven around investor outcomes, investor protection, and transparency of processes. And there was a lot of concern about what MiFID would do through that process, not just the burden on the investment firms, because it has been a burden. It's been a regulatory tax. That doesn't matter how you framework it. It has definitely cost companies a lot of money. But interestingly, to my opening comments, as we're heading out of 2020, we just hit a black swan event, and all the concerns about an over-regulated industry through MiFID II haven't really come to light in terms of those concerns about liquidity, the ability to transact, everything from best execution to depth of markets. And we've seen that, as I said at the beginning, the industry has been able to prove a resiliency, operational resiliency, and broadly speaking, not necessarily reflecting on the absolute performance of the markets, but the way in which clients' portfolios have been managed. And they may have had some market negative outcomes, but they haven't had the egregious outcomes that they may have experienced through unprotected products and services in a sort of 2008 environment. So if you think about MiFID, it's really trying to treat clients fairly across the board, trying to create the best outcomes, and creating value for money, all in a sustainable way. So I think MiFID has actually delivered, although it's been a very painful journey for the industry, has delivered a higher quality product that is driving greater transparency if you're the client. I mean, we'll still sort of, on an ex post basis, you know, opine whether returns would have been better. But coming out of 2020, we don't have the client events that we had in 2008 and 2009. So I think that's great. And I think also, just touching on one of the previous questions about active and passive, I think this does also raise the bar in terms of transparency of active management versus passive management in terms of value for money and what really is alpha. Because you looked back in 2008 and before, a lot of active managers weren't actually creating alpha, they were creating leverage beta. And as the sophistication of index managers picked up, the hurdle of active managers of finding true alpha was raised. And I think MiFID is trying to pull that out even further. So I think generally it's a good thing.
I agree, and I guess striking a balance between investor protection and business commercials, it's a fine line. I mean, I guess it'll take a couple of iterations before you get it right. We'll go on to the live polling question for this section, and then move on to Mike. So the question here is, what areas are you focusing on to drive innovation into your investment research process? Hear from the audience, and then we'll get Mike's expert view on this. I think Sid, that's fine. So we've been talking a lot about challenges, Mike, but equally, I mean, there are a lot of tools now at our disposal. There is much more powerful technology. There is big data. There are analytics. There's a lot of solutions that investment research teams can sort of turn to, ESG for differentiation, etc. Can you share anything that you've experienced, how teams are responding using these avenues?
Yeah, just to tie in sort of with what both Dave and Bill have said. So I think, and it's pretty obvious, right? I mean, data, to all intents and purposes, is at the heart of asset management. And without data, you know, you're kind of nothing in asset management to all intents and purposes. Dave talked about, you know, a merger. Effectively, Standard Life Aberdeen is a byproduct of a merger between Standard Life Investments and Aberdeen Asset Management. The integration that Dave talked about is much harder if you don't have a very clear data architecture on which to ultimately run your business. Bill touched on MiFID II. At the heart of MiFID II is transparency, and therefore it's data and the ability to be able to surface data, share data, pass data to, you know, various different regulators from a reporting perspective. And then the point that you make, absolutely, in terms of the question, Paul, is, you know, ultimately, if you have a very sound and solid data architecture, then it is a question of being able to flex that for things like ESG, where you're then dealing with a whole bunch of different data attributes in order to be able to satisfy different regulations, to be able to demonstrate that you've managed the assets in line with the portfolio that ultimately you've agreed with your clients, who may well have signed up for TCFD, or SFDR, or the various different regulations that ultimately are clearly coming into play as far as ESG is concerned. And I kind of separate out sort of structured data from unstructured. And I guess structured data is making sure that ultimately we've got the machine which allows the investment managers to, you know, manage within the compliance rules, that ultimately allows them to do their VAR calculations, that ultimately allows them to be comfortable that they're managing the portfolio, as I say, in line with the requirements. And then there is the provision of a whole, you know, whether it's a sandpit or whether it's whatever we want to call it, where we can ultimately provide portfolio managers with a whole raft of data that they would ultimately like to play with. And then point things like Python and R and the various different toolings, data science capabilities that exist to allow them to scenario plan and ultimately, you know, look and identify what it is that they would choose to do with their portfolio. So I think technology in that space will speed up the investment research process. I'm not a great believer that ultimately, robots are going to run portfolios, but I do think you can leverage technology to ultimately help drive and inject more pace into, the investment research process than may have been done historically. But as I finished where I started, that effectively, in order to run an asset management business effectively, you've got to have a very clear view of your data architecture, and that is from just cost effectiveness, from making sure that ultimately you're taking the right kind of investment decisions, and ultimately being able to bring together corporate entities should you go through M&A type activity. Without a clear data strategy, clear data architecture, it's like running through treacle at times.
Agreed. I guess we talk a lot about consolidation, but I guess getting companies to sort of talk to each other, data to sort of interface is the bigger challenge. And yeah, a lot of tools, but I think it's easier said than done marshalling it all effectively. So shall we see what the audience had to say about this? Yeah, so areas focusing on ESG research had 2/3 of the audience answering on that, and followed by big data. All right. So going on to the third section, and as I said, I mean, now we're getting into more operational and more immediate, shorter term issues. So we'll start with Dave here. I mean, like all industries going through this pandemic and various other crises, the biggest challenge is operational efficiency, streamlining your business model, getting much more efficient. Can you share something, some of the changes you're seeing in this industry? I mean, addressing operational efficiency, Dave?
Yeah, sure, happy to. And I'd say, much like some of my prior comments, I'm not sure this is all a function of the pandemic either, because I think the process of looking for greater efficiency and reducing cost structure is really almost a continuous one in any well-run asset management shop. Faster, better, cheaper have always been. The question is how you get there. And I obviously technology and automation can be part of the equation, but these do have their challenges, and they tie to data. To Mike's comments, the technology and automation have very little meaning if your data is not squared away. But because of that, I also believe that offshoring, when it's well done, can also be a very legitimate part of the equation. So some firms look to establish their own operations offshore. My own experience has been more working with a partner firm that allows you to avoid sort of the de novo creation of completely new infrastructure. And when you can partner with a firm that brings domain knowledge, that is, knows the business, and brings strong internal management, I think the benefits can be quite significant. Cost savings are real, and at scale, they really add up. Tasks can be bifurcated, so you keep the most strategically important elements in-house. And you can pursue more of a follow the sun model in terms of complementary timing for workflow. We've been doing this for a couple of years now, primarily in the areas of RFP and consultant databases, as well as some compliance work, and are actively looking at other areas within marketing, such as presentations and collateral, as well as investment research. Now, offshoring can be a sensitive topic for many firms from an employee relations and morale perspective in terms of quality and control relative to concerns over language and writing skills. And there can be confusion as to whether you're substituting variable costs for fixed costs, which generally you are not. What you're doing is, these are de facto fixed costs, but they're at a lower level. But I think the bottom line is that when it works well, the savings can be meaningful, and the personnel working for you offshore really become part of the team. I do have to say, in the spirit of transparency and full disclosure, we are working with Acuity Knowledge Partners, the sponsors of this webinar, but it's been a very good experience.
Thanks, Dave. And for full disclosure, Dave's not being paid for any of this, but all that you said is music to our ears. Actually, technology is something that everybody brings up, but our own experience is that actually getting and integrating relevant contextual technology with domain in front office is much harder than people talk about. You have to get specialists to understand each other. You need to have seamless sort of communication and constant supervision to really come out with technology that helps domain front office operations. So what are your thoughts on that, Bill? What is your experience been applying technology to?
Yeah, I think whether it's technology or outsourcing, the two sort of are co-joined. But when, and maybe there's a sort of a bit of a segue back into MiFID here as well. I think, which is that as I look at whether it be passive or active management, any investment decision has to have a discipline, a repeatable set of logic, so you can make different decisions, but under an architecture and a discipline of investment process, and it has to be repeatable and it has to be disciplined. And I think there are points that historically we have probably not considered, where there are elements of that investment value chain that are definitely can be leveraged through either technology or outsourcing partners. I think the collision of how far that can go up the value chain into the sort of real portfolio is to a certain extent hindered by regulation, things like MiFID, where they in its spirit of transparency for the clients, they want to be able to highlight the actual decision maker at every point in time of decisions that hit that fiduciary asset decision. And I think that sometimes is difficult to outsource, especially if you are outsourcing in an environment that may not have the same sort of compatible regulatory framework. So not all our outsourcing partners would tend to necessarily be MiFID licensed firms, for example. So there's a limit to how much of that value chain you can leverage and discharge beyond your sort of your licensed umbrella. But it's definitely taking a much greater position in the investment process. And I think you can talk about quite a significant rules-based framework around indexing. So there's a lot of that pre-work that can be done. And there's quite a lot of, I know you touched on research, there's quite a lot of fundamental and quantitative building blocks that can be done prior to that actual sort of investment decision being made. And just to Dave's previous comment, I think the most successful experiences I've had on this is when the offshoring technology or the team feel like they're an onshore team with the rest of the team. If you try and outsource it and you try and behave like you've got an SLA, if you like, and they're not part of the real investment team, things get culturally break down very, very quickly. So yes, I think I've seen the rise of it, and I think there's definitely a lot more of this to come.
Thank you, Bill. So we'll take the live polling question now, Sid, and then so would you consider offshoring non-core activities to stay competitive? Thanks, Sid. So, Mike, since there's been quite a bit of a discussion about offshoring and outsourcing,
Yeah.
can you share any experience of, I mean, like using a third party or your own captive uh, shared service team?
Yeah, so I think I would focus, like Dave, in terms of third-party service provision, because I think, depending on if I think about us as an asset manager and our size and scale, our goal is really to try and focus on what's core and then ultimately outsource sort of what you would deem to be commodity type services. So whether that be, we don't really develop our own software. We buy in package applications. Ultimately, from a middle office perspective, we're looking to leverage capabilities from third-party service providers. We're looking to extend the edge of that envelope in terms of client reporting, performance measurement. So as an organization, it may seem bizarre as the global chief operating officer, but my goal is to have as few people as possible, probably within the COO world. But those that I do have effectively have to be able to work with portfolio managers to understand what it is that they're trying to do, what it is that they're trying to achieve from an investment perspective, work with the distribution people to understand the different types of clients that we are pitching for, to understand what those client needs are. And then to ultimately work in partnership with our third-party service providers, of which you probably don't want too many, to ultimately make sure that the take-on experience, the client service that is being provided, is commensurate with the process that you've gone through in order to win the client in the first place. What I would say is what we do need from all of our third parties is transparency. So, we insist upon effectively getting a look through into how things are done in order to be able to track MI, in order to be able to track key data points. That doesn't mean to say that I'm managing the process, but ultimately what it does mean is that we can have an optimal end-to-end value chain where I'm not simply repeating a whole bunch of tasks and activities because I'm not quite sure what's being done by my third party. So I think fundamentally, in the asset management space, if you look at the role of the chief operating officer, probably over the last decade, if not longer, it's fundamentally shifted from sort of an organizer of lots of people doing a whole bunch of tasks and activities to stitching together a pretty complex web of supplier arrangements, all designed and sort of destined to try and help improve what we do, but also to try and, focus on core and actually from a commercial perspective, make sure that, it's more optimal, it's less capital intensive from our perspective. But ultimately, as I say to our CEO, you want world-class technology, but you don't want to pay world-class prices. So therefore, my job is to try and work with tier one technology companies to ultimately try and ensure we get that service provision built into how we operate. So I think fundamentally the role of the COO has changed and will continue to evolve and change working with third-party service providers.
Thank you, Mike. Yeah, no, I think there was a lot about trust and partnership, and that is a certain amount of monitoring, but not micromanaging. Maybe we can just see what the audience had to say about this. In terms of, I guess it's pretty much split about some immediate, some will wait for some time before considering this option. So going to the final section, and it's basically addressing the elephant in the room, talking about COVID, work in the COVID, work in the post-COVID world. So starting with Mike, what are the biggest challenges you faced during this pandemic?
Yeah, so I think, without a shadow of a doubt, the first challenge was to get everybody working remotely. However, having worked in global asset management for what is a lifetime, we'd already come up with the means to be able to distribute technology to get people working remotely, predominantly based on international travel, but ultimately in different locations around the world, around the UK. So once we had been able to pretty much guarantee everybody with the appropriate tech provision and the access points, for me, it all became about collaboration, and it became about making sure that people remain connected to the organization. I think we trained ourselves over a pretty extended period that, you know, we all needed to be in one place at one point in time during the hours of, you know, 7:30 till 5 or whatever time it might be. And effectively, we've kind of, you know, because this intervention has gone on probably more than any of us may have first anticipated, we've kind of devised different ways of working, different approaches, the utilization of the technology we're using today to have these kind of conversations. So I think ultimately one of the key sort of lessons learned is, you know, what does it mean for the future of the office? I think the office does have a future, but I think you've got to think about ultimately how you get maximum leverage from it, how you bring people together to collaborate, to innovate, to train and induct people. I mean, one of the things when we were preparing for this call is, you know, we're all beneficiaries of having been sort of brought into organizations, trained, inducted, spent a lot of time with other people. You've really got to think about your younger talent that you've ultimately hired. How do you make them connect with the organization when they may have spent months and months on the end of Zoom calls, Teams calls, whatever it might be? So I think the big challenge is less about us old timers, if I could say that without being too discriminatory, ultimately, but much more about how do you get the next generation of talent feeling as connected to an organization when they've probably not spent a single foot in the door for a period of time. So that's where I think we've got to focus is how do we devise more of a hybrid way of working, which brings the benefits of some of what we've encountered with the natural benefits of being able to have a good face-to-face conversation with your colleagues on an ongoing basis, because there's no substitute for that when it comes to certain types of activities.
No, very true, Mike. I think one of the biggest challenges we face in recruiting is this whole thing about lack of face-to-face contact and passing on the culture and the values. I guess a very real challenge. So going on to Dave, how are you reimagining costs in the post-pandemic world?
There's going to be a little parallelism and overlap with some of Mike's comments, but obviously that issue of face-to-face applies every bit as much to relationships with clients as it does to internal relationships as well. And I'll have to say, I believe that virtual meetings as a generality have actually proven to be quite effective, and they're here to stay. That doesn't mean they're going to replace face-to-face completely, but they'll certainly be a much larger part of the mix. And tangibly, this offers significant opportunity for cost savings. When you look at the cost of internally managed and sponsored events and meetings and conferences, you know, which are very common in our industry, they easily consume many millions of dollars for most firms. And apart from the sheer reduction, if we're really honest with ourselves, I think it's become clear that some of these activities were not really worth the money we were spending on them to begin with. And that's a little bit, it's an awkward thing to admit, but I think there's some truth in it. And in the associated travel and related cost, it all totals up to a considerable increment of expense as well. You know, and the cost of virtual conferences and webinars and video and other digital tools, they're not meaningless, but they're certainly much lower. Most of them represent more of a fixed cost than a variable cost once you get the infrastructure in place. Portfolio managers can find more time to spend with clients, and sales personnel spend much less time on the road. And again, this is not an all or nothing at all proposition, but it does raise questions as to whether you will need as many people on the ground. Are offices needed in all geographies? Is there a greater role for hybrid mechanisms, such as e-wholesaling? And this is where I will overlap with some of Mike's comments very meaningfully, because I think a thornier question is whether work from home can be a permanent modus operandi and what it might mean for a firm's office footprint. And while I do think greater flexibility for employees can make a great deal of sense, that's not the same as never being in the office. So, you know, the concerns Mike expressed, corporate culture, training, assimilation of younger employees, discussion of strategic topics, spontaneous creative thinking, you know, when you're with a group of people and say, let's poke into this office and go to the whiteboard. It doesn't seem obvious to me that a substantial reduction in the cost of core real estate is necessarily a likely outcome. So I do think there are millions of dollars of prospective savings as we see what the balance really what the sensible balance looks like once we come out of the other side of this pandemic tunnel that we're in right now.
Right. At least in some ways, I think this pandemic has accelerated certain changes which might have taken longer otherwise, but probably were inevitable anyway. A little more digital delivery, more flexible hours. Maybe not everybody needs to travel all the time. So some benefits there. So just going on to the audience polling question, Sid, want to put that up? Have fewer face-to-face interactions with clients impacted your business? Not a huge impact. Yes, only a short-term impact. Yeah, that should be easy to answer. So, Sid, I think that's fine. So the last question, the last section is for Bill. Given work from home, fragmented locational delivery centers, there are many new challenges. What are your concerns now in terms of when you talk with business partners, either within the company or, within the country or outside?
So I think, and again, trying not to overlap with my panelists, but I think we are in concert here. So one of the things I'll start off by saying is I think the initial early concerns of, you know, collapse of the real estate inertia in the cities and that this was the end of the beginning is a false dawn. And I can step through why I think that is the case. And I think as the longer the sort of the pandemic or the sort of restricted activity goes on, the more real I think the benefits of a hybrid model will come through. I think I think it's today's comments. I think leveraging our current fixed costs and our real estate footprint will be key. That's different from everyone leaving the city of London or Paris or New York. I think it's just a matter of sort of reimagining the operating model. And, you know, we're looking at ways of, if, you know, previously to the COVID, we were running at 80% capacity in our real estate, we're going to probably strive to get to 130%. And you only get to 130% if people aren't in the office the whole time. So I think that's, and I think also COVID, as I started off at the beginning, has allowed the industry to show its operational resiliency in terms of being able to cope with the everyday functionality. But I think what it has also highlighted, and as I sort of reach into my teams and get feedback, and hopefully as we're coming to the sort of the last lap of the COVID experience, what we're seeing is that the emotional response or the emotional behavior that drives the business and drives outcomes for our clients has definitely been missing over the last 9 months. And what I mean by that, if we can all accept that we've passed the operational resiliency exam with relatively, you know, high marks, the areas that are definitely missing are the emotional inputs into a process. And that would mean creativity on one side, where we just do not spend enough time emotionally as human beings getting together and being creative, and that could be spontaneous or it could be planned, but it's much more difficult to do it over a sort of a VC. And I think the other thing people forget as well is the conflict resolution as well. I think, you know, as part of life and as humans, we do have challenge, and we have constructive challenge, we have challenges that are less constructive. But by sort of emotional empathy, we can have conflict resolution. And that's very difficult to do virtually. Sometimes you just need to get in a room and feel the emotions. And sometimes that's difficult to quantify. So I do think we are going to be in a better place. I think it's going to be incredibly good for diversity. I think it's going to be incredibly good for work-life balances and generally mental health for workers. So I think that's all good stuff. And I think going into the sort of the heart of the question, I think, which is the offshoring and the outsourcing, I think what this does do is just shows the resiliency of being able to do things differently, where you might have had a sort of authentic concern that, you know, you can't outsource, you can't offshore because there's a potential operational threat, etc., etc. So I think that that's going to be swept away after this experience. So I see that we are going to actually, COVID's forced us into probably a better way of working, and that's not necessarily a bad thing, and it will help us build back better. And I think that the industry will be better for it in the long run.
Yeah, no, I think that's, I think, yeah, there's always an opportunity on the positive side. And I think that's one way to view this. And one of the biggest challenges for us has been to upgrade the information security, because now there are so many fragmented business locations. So given the amount of hacking and all the possibilities of information loss, that has been a big focus for this company. But thank you. Thank you for all your thoughts on this. Sid, can we just have a look at the audience answer? So the general view has been not been a huge impact. There have been alternatives to this, and there's 44% who said it has impacted their business. We started this about 5 minutes late, and we would, if okay with people, extend this by another 10 minutes for the Q&A session. And the way we will do is just type in your questions into the Q&A window, and then Sid will forward it to us. Right. So there's been quite a bit of attention and interest on ESG investing. And will ESG soon become an asset class on its own? And it's open to anyone who wants to take it. So Mike and Dave, any thoughts?
Yeah, I'm happy to offer an opinion. I mean, you know, it's an evolving area. I think ESG is here to stay. I don't think it's just a phenomenon of the moment, because it really ultimately reflects long-term issues of risk and relevant factors, you know, to consider in security selection. That being said, my own view is it is not a discrete asset class. There are certainly strategies that are very focused on sustainable investing or others, but I think for it to be meaningful, it's the way it becomes integrated in with everything we do across all the different asset classes and strategies that a firm offers.
Yeah, no, I think you've summarized it fantastically well, Dave. I would absolutely concur. It just becomes sort of part of the DNA.
So Paul, I'd probably say, I'll make a controversial statement, but it's not actually that controversial, which is I do think ESG will go away. but I don't think it will go away because it is no longer relevant. I think it will go away because it will become the norm. And I think that you won't give it another, I don't know, 5 years or so, you won't talk about ESG investing because the principles of ESG will be embedded in, like the principles you have in your index rules. It will be actually at the heart of investing. No one will want to invest if it doesn't have X number of E criteria and X number of S criteria, and if the companies can't demonstrate good control over their G, then you won't be able to invest in that sort of non-ESG universe. And I think, you know, I think we're seeing this turn, although it's a bit like an oil tank in the institutional space. The institutional space is beginning to turn, and sort of ironically, it's been led by the retail space because the retail has been very attuned to a lot of this sort of climatic concerns we've had over the last couple of years. And institutional investors tend to move a lot more slowly because of the different layers of decision making. But once they start moving, as we are seeing them, and I also believe that historically there was always a bit of a debate whether there was a return discount or return premium, whether you're in a clean or a dirty market. And I think that's basically been debunked, the myth that you're going to have to take a return discount if you want a clean portfolio. In actual fact, the evidence will show that actually investing in clean ESG portfolios is a self-fulfilling prophecy in terms of getting better returns.
Right. Thanks. There's a question about US elections impact for global asset management firms. Dave, you're the American on this panel. Any thoughts? I think more about any major policy changes you anticipate?
This is such dangerous turf. I think it would probably be foolish to offer an opinion. I will say this, that many asset managers feel that the combination of a Democratic president and a largely Republican Congress will lead to a certain amount of stalemate, which many of them find quite attractive in terms of how things may work economically. I get that. From my point of view, it remains to be seen. So.
Sure. Anybody from Europe? I mean, since
yeah, I think maybe just to put in 2 cents worth on this is that I think, without making political comments, but I think a world where, and looking at our industry, a world where we don't have globally coordinated leaders and regulation, where we're looking for global liquidity and global asset prices, a framework where you have the West in itself unconnected or discoordinated in terms of its regulatory or legal or its political framework is not a good thing. So whether I'll leave it up to people's own political opinions, whether they think that would be better off under the new government or the old. And I suspect you can guess what I feel on this. So I think we're probably, for capital markets and the asset management industry, potentially in a better place than we were probably 6 weeks ago.
Right. Michael, turn to you. This is about where do you see M&A activity in the EMEA region going forward?
Where do I see it?
Or what?
So, I mean, I think, sorry.
No, what asset management M&A activity do you see coming in the EMEA region?
So I think it's what we touched on earlier. I mean, I think, you know, having lived through the experience of one acquisition and a pretty large merger, you should certainly go into it with your eyes open. I think you have got to have a very clear driver as to ultimately why you would choose to do it. I think there will be more consolidation. I think, you know, there will be organizations who, through COVID-19, are probably not in as great a shape as they might otherwise be. But I do think you've got to be really clear about why you're doing it, because there is a lot of fallout associated with M&A type activity. but it can absolutely be worthwhile. It can give you scale, it can give you breadth, it can give you geographic benefits, the whole raft of sort of benefits. But it is a huge undertaking, and ultimately, it's something you should go into with eyes wide open.
Right. I think in the interest of time, we'll take this last question, and this is about what are the learnings on marketing, biggest marketing learnings from everything that has happened this year? Shall we start with the Chief Marketing Officer first, and then go on, Dave?
It's funny, again, I often don't look at things through the eyes of the pandemic, or rather I reflect on what is different now. And I've talked with a lot of colleagues, and one of the things they have pointed out is how incredibly important it is to have good coordination and communication with everyone in the distribution organization. There's often thought of as a friction between sales and marketing, for example. Honestly, it's got nothing to do with the pandemic whatsoever. I think it's critical that those kinds of issues, which are often cultural and personality driven, be addressed. And from my point of view, given that's an area we spent a lot of time focusing on, what you can see is the powerfulness of it when it's behind you rather than in front of you. Because we went into this insanity, and honestly, it's been full steam ahead from day one. We've been incredibly productive. If anything, it's made us more global. And that collaboration and communication has just proven to be almost immeasurably important. But again, I happen to think those things are important under any circumstances. And so we just sort of took it, maybe I'd say took advantage, made lemonade out of lemons. So I don't know that it's a profound recognition. It's a reinforcement of what I think are basic precepts of running an organization well.
Thanks, Dave. Any thoughts, Bill, Mike?
Yeah, I mean, I think one of the things that I firmly believe is that the COVID, I think the global financial crisis taught us so much that we learned from and have been able to put into play to cope with the Black Swan event that ultimately Bill talked about during the course of 2020. I dread to think what we, I kind of don't want to say, had the global financial crisis not happened, I'm not sure how we would have coped with COVID-19. But I do think as an industry, we learned so much from the global financial crisis and applied a lot of that learning, rigor, discipline, and process. So we learned from experience, but I don't think we've taken the time to reflect on that too much yet. But I absolutely do think that we learned so much from that crisis of 08, 09 that has been replayed during 2020. And for that, we deserve a lot of credit for helping financial markets around the world to have functioned through, as Dave said, a crazy time.
Yeah, I would concur. I mean, I think I never thought we'd be thankful for the global crisis, the financial crisis that is, but I suppose, thankful for small mercies. I think that although it was very painful at the time, it has made the industry so much more resilient. And I think Mike's spot on. Going into this without the experience and the tightening up of everything that the industry's gone through over the last 7 years would have been, I think, catastrophic. So
thank you, Bill, and thank you, Mike, and thank you, Dave. And we were gone beyond the time we sort of asked people for, so we'll conclude it here. Once again, very sincere thanks on behalf of Equity Knowledge Partners to all the panelists and all the audience for your time and your thoughts. And just for full disclosure, just to give perspective, we've been talking a lot about the challenges of this industry, but this industry records operating margins in mid-30s. It has recorded AUM growth of about 15% last year. and continues to grow. So these are all business numbers that industry leaders in other industries would feel for. So it is in a pretty good state. It's just that there probably could be areas which can improve to make it even more successful. So hopefully this evening has been of some value to all the participants. And one earnest request is that please kindly fill up a feedback form that will pop up on your screens. It'll take 30 seconds of your time, and it makes a huge difference for us. So with that, I conclude. Thank you, and wish all those celebrating Thanksgiving happy Thanksgiving and happy holidays. And please,
I'm the Yankee, or at least on the speaker panel, but thank you. It was a pleasure.
likewise, and stay well.